Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent jobs report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So at the end of the first week of every month, I think it's useful to go through the labor market data just to see if it's holding on strong or if there are cracks starting to show. The reason we care about this is because the labor market will likely ultimately dictate when the Fed is compelled to finally cut rates. So we're going to go through a lot of the different reports. Most of it, a good portion of it looks fine, but there are a few concerning areas that I think merit our discussion. So the first thing we'll look at here is the unemployment rate. It is still at 3.7%. Furthermore, the 3.9% that we got previously was actually revised down. So now you can see that the highest the unemployment rate has gone is just 3.8%, and then now it's been back to 3.7% for the last couple of months. So this one is still relatively low. It is trending generally higher, right? You can see that it's sort of trending higher highs and higher lows, but it is a very slow moving process. And note the business cycle can often take years to play out. We could look in specific categories as well. We could look at, say, just 16 to 19-year-olds. This is one that we looked at previously because it was spiking a lot. Last month, it came back down from 13.1% down to 11.4%. Now it's started to go back up again, so we'll continue to keep an eye on that. The unemployment level, you can see that it went up by about 6K, so not a huge move there. If we were to look at the unemployment level by reason for unemployment, there might be some interesting data here. For job losers, it stayed relatively flat. Job losers on temporary layoff, though, did go up by about 28,000, so it is making somewhat of a move. You got permanent job losers, which is still moving higher, but this last month it went down by 46,000. We can also look at new entrants to the labor force, which I think will be an ongoing story because I think there's been a lot of people that have been out of work or they haven't been working. Perhaps they didn't want to get a job. They were doing other things. But the longer, the further into the cycle we get, the more likely those people will feel like they have to go get a job. And you can see that new entrants to the workforce, the unemployment level has been steadily going up, right? And if you were to look at a year-over-year percentage change and maybe smooth it out with, say, a 3-month moving average, you can see that it is getting relatively high in terms of the year-over-year percentage change, right? It even hit 28% not too long ago. We will continue to move on, though, because there's a lot of data that I want to get through. I do want to at least briefly look at this. This is a new chart that, well, we showed this chart once before, but now we've added some functionality to it. This is the number of states where the unemployment rate is rising. And the default chart is just compared to 1 month ago. So this is what we previously presented. And you can see that there's 36 of the 50 states where it's currently going up as compared to a month ago. Although monthly data is quite noisy, and so if you were to look at it on a 3-month basis, you can see that it's up to 44 states. Now, it is worth pointing out that just because the unemployment rate is going up in most of the states, it does not always mean that you're in a recession. There are times, even like 2022, where the unemployment rate was going up, measured 3 months, 3 months previously in 42 states, and we were not in a recession in terms of the unemployment rate. You can see there's a period in 1995 where this went up a lot, no recession, and there's other cases as well. This, though, where it currently is, note, and again, like this is just a statement. It's not me speculating on anything, although people like to draw their own conclusions, but there has never been a time in the history of this chart where it was this high and we were not already in a recession, right? I mean, it hasn't happened. And that's not to say that this time can't be different, but I do think there are a lot of people that discount this data just simply because of all the lagged effects of monetary policy, but there are some concerning signs, right? And we're going to talk about those. There's been some positive signs as well. There's sort of a mixed bag, right? It's sort of a mixed bag. If you were to look at it from 6 months ago, you can see that it's still only at 32. And so, you could compare this one to 1995 and see that, it went all the way up to 33 and we were not in a recession. So if this one were to continue to rise over the next few months, then it would get increasingly worrisome. We could look at alternative unemployment rate measures. There's, of course, the U1, which is greater than 15 weeks. This is one that had been moving up, and then last month it dropped down to 1.3. Now it's back up to where it previously was, so not a huge change there. There's also job losers, so this is U2. And I mean, it just sort of seems like it's slowly going up, right? Not too quickly, but it's slowly trending higher. And I mean, that's not different, right? Like that's what it normally does. It slowly builds out a base and then it starts to move higher. And one of the reasons why once it starts to move higher, the reason it tends to continue moving higher is because if you think about how long it has taken for all these interest rates to have, an effect on the economy where it's slowing the labor market down, by the time it's obvious that the unemployment rate is going up, the Fed will probably be so far behind the curve that they'll have to cut a lot. And that's, that's one of the issues with reactionary policy is, by the time you act, it's often too late. It's something to sort of think about. On the other hand, predicting macro moves is very, very difficult. And I imagine if they were to carry out policy based on what they thought was going to happen, rather than what's actually happening, that could also be fairly detrimental. We can also look at people not in the labor force. And this actually ticked up a little bit this month. It went up by about 845,000. If we were to just look at a year-over-year percentage change of that and maybe take, say, like a 3-month moving average, you can see that it is still relatively low, all things considered. Now, before we get further into all this data, I do want to at least mention a couple of areas that are concerning. Because, I mean, everything that we've shown so far, it's not really that concerning, right? It's not really that concerning. It seems like, yeah, things are slowing down, but it's not, it's not to the point yet where you could unilaterally say, all right, well, this is a recession. I would say the more concerning reports that came in this week are these two right here. So total non-farm hires, this was a pretty big drop off, right? And if you were to look at sort of the history of it, it doesn't really look that different from what we saw during the last two slowdowns in the economy. And in fact, if you were to look at a year over year percentage change of this chart, you can see that it's now at negative 12.6, right? So it is getting relatively low, and it's been negative for quite a while now. So that was one concerning thing, just to see how big of a drop off that was. The other concerning thing comes from the thing that came out today. That's the ISM services employment. If you're not familiar, this is the non-manufacturing employment in the U.S. It fell to 43.3. Now that might not mean anything to you. But I would say that in general, if it's above 50, it means expansion. If it's below 50, it means contraction. And that's a big drop. Now, it might be foolish to jump to a conclusion based off a single data point, right? I think that would be fair to say. There's always a chance that we get this data point again next month and it just jumps right back up to 50, and we look at this as just sort of a fluke in the data, perhaps influenced by the holidays or by temporary work. I don't know, but that's a concerning data point, right? Whether you think the economy is holding strong or whether you don't, it's hard to look at this chart and not think that looks concerning. And you might say, well, Ben, how does it compare to prior data? Because you're only showing about it going back a year. Well, if you were to look at this is what it looks like. This is a big drop in a single month. The last time we saw a drop like that, I mean, you look at the pandemic compared to this. Yes, this was caused by a pandemic, but if you were to just look at the data and not what it was caused by, right? Whether it was the financial crisis, whether it was the dot-com crash, whatever. You just look at the data. This is concerning. And what's interesting is that in the recession that came out of the dot-com crash, this metric, the ISM services employment, never even went to this level, right? It never even made it to this 43 level that we're currently at, 43.3. The expectation, by the way, was 50.7, and it came in at 43.3. That is a huge miss, right? It's a huge miss. And so I think that it is worthwhile to consider, because, we were talking about some of the narratives that will be prevailing this year, and on the recent live stream that we did. I think one of the narratives could just be, crap, how much, how badly has the Fed screwed things up, and that could sort of put a sort of, a rift in people's plans. So I think this is a data point that, we have to follow up on next month, because you don't tend to see drops this big in the labor market in the ISM services employment. This is not a common thing to see unless something is very, very wrong. So, there's a part of me that wants to reserve judgment on it until we get more data. But again, if this is a real data point, then the market will likely start to react to that. And arguably the S&P already has. I mean, the S&P is it's gone down. This was a pretty big drop this week. This was in a single week from from where we closed the last week, the S&P dropped, about a 1.5%. Now, it's not huge, right? I mean, it's nothing that, is going to necessarily prove a macro theory right or wrong. And any person who would look at this chart would say, well, I mean, it's not that different from all these other candles that we've seen. And that's true. But I would say, again, that when you look at this chart, we will need to follow it up in a month and see, where does the next data point come in? Does it come in at 43 again or lower? And if it does, you probably will get a rate cut in March. If it doesn't, and if it goes back up and then it's just a fluke, then, we just kick the can down the road. And, this business cycle is really good at kicking the can down the road. So I would say those are probably the two most concerning things: the new hires dropping, and the ISM non-manufacturing employment dropping all the way down to 43.3. I mean, I wasn't expecting that at all. I mean, I was generally expecting the labor market to soften up, but to go from 50.7 to 43.3 in a single month is a substantial drop. What's interesting is just how conflicting the reports are, right? Because on one hand, you have the ISM services dropping like a rock. You have new hires going down. But on the other hand, you still have an unemployment rate that's only at 3.7%. So it doesn't really feel like there's a lot of consistency in these reports. It seems like some reports paint a rosy picture of the labor market, while other reports, show a pretty damning view of the labor market. So, again, it's hard to know which one is going to sort of prevail in the end. But I do think there are some concerning things with some of these reports, whereas other ones think there's nothing absolutely wrong at all. And and we'll talk more about those. But let me just go through the list, because I don't really want to miss anything. If we were to look at the labor force participation rate, it dropped by about 0.3%. Not a huge change there. There's the civilian labor force level dropped by 676,000. Right. So this is also concerning. And I look at this, and then I look at total non-farm that came out today. I'm like, well, which is it? Because this one here put in a lower low, right? I mean, you can see it was putting in highs, and then put in a low, and then put in a higher high, and then now it put in a lower low. And I mean, it has done that sort of before, right? I mean, you can see here it went from a high to a low, but it didn't really, it didn't put in a higher high, it just put in a lower high and then a lower low. But this is a big drop. I mean, this is a substantial drop, negative 676,000 in a month. I mean, just look at a month over month percentage change, and you can see that we haven't had a percentage change drop that large, right? Negative 0.402%, really since the beginning of 2021. So it's been a long time. Now, again, with the labor market, you get data points that are flukes all the time, right? I mean, like imagine if you had looked at this down move right here and said, oh, that's it, right? Okay, no, right? It still continued to go higher. So this is one of those things like the ISM services employment where it's a bad number, but until we see the data follow up, it's going to be hard to make any concrete conclusions. If you were to look at a year over year percentage change, it shows, it was at 2.24%, and then it dropped to 1.49%. That's a big drop. And again, you can see that these gray shaded regions, these recessions occur when it's dropping relatively quickly. So it doesn't really matter the level that it's at, but it's the rate, it's the change, it's the rate of change from that level, because there's plenty of recessions where this number doesn't even go negative, right? But it's the rate of change that I think is more concerning. So that's something to keep an eye on. If you were to look at the employment level, right? So this is the report that we got out today that is sort of like a polar opposite of this one. This one is down 676,000, and we could look, we could break it down into different categories if we wanted to as well. But if you were to look at the employment level and look at total non-farm, it went up 216,000. Now, granted, one of the reasons it went up this much was because some of the prior months were revised down. So it's not as hard to beat expectations when prior months are revised down. Be that as it may, it still is a positive number, right? And if you were to look at a year-over-year percentage change, you can see that basically all prior recessions corresponded to this going negative, and it's currently at 1.75%. So, when you think about the labor market and all the excess in the labor market, you can see just how much excess there's been. I mean, February 2022, the year-over-year percentage change was 5.2%. Then by February of 2023, it was all the way at 2.81%. And now looking at the December 2023, it's at 1.75%. So it has been dropping, right? It's been dropping pretty quickly. It's just that it was coming from a very, very high level. And again, you can see that all these prior recessions corresponded to this metric going negative. And it's not negative yet, but it is trending in that direction, right? It's trending in that direction. And there's some people that are sort of betting on a soft landing where it, doesn't go negative. And other people that are betting on a hard landing. And here it is looking at it on a quarter over quarter basis. And here you can see that it's just been slowly trending down. I think it's worthwhile to take, say, like a 3-month SMA of this and see kind of where it's fallen from. So it topped out here at about 1.4%. Today it's at 0.334%. So it's fallen a lot, right? And honestly, it probably will continue to fall until we get back to looser monetary policy. So one of the issues with getting all these conflicting reports where the unemployment rate's 3.7, whereas the ISM and new hires are falling off a cliff, one of the issues is that it might make the Fed delay rate cuts even longer. And the longer they delay rate cuts, the more likely we are to get a hard landing. The sooner they start rate cuts, the more likely we are to get a soft landing, in my opinion. That's just my opinion. I mean, I could be wrong about that, but that's my general view on the market is that, the longer it takes them to cut, it could be an issue with all the lagged effects of monetary policy catching up. And if you think about, if this is not just a blip where it goes back up next month, if it goes down again, let's say it goes to 40 or something, where does that leave the Fed? I mean, they'd be so far behind the curve on cutting that you can understand why risk assets wouldn't like that very much. Okay. On the other hand, if it goes back up to, to 48, 49, 50, then, they're probably just going to shake their head and be like, well, what do you guys want us to do? I mean, you still have inflation that's still pretty hot, and the labor market is still, the unemployment rate is still 3.7, 3.8%. So it really depends on which of these labor market reports are more believable, because some look like this and others look like this, where, again, when you look at quarter over quarter growth, normally it's when it's negative where recessions occur, and it still isn't negative, right? And it's not even dropping that quickly. I mean, 0.371, then 0.383, then 0.363, then 0.37, then 0.334. This is a 3-month SMA of the quarter over quarter change. So yeah, I mean, it's dropping, but it's not dropping that quickly, at least not yet. But the issue is if this is an omen for what's coming. I don't know. We can look at non-farm private payroll. Actually, before we do that, let's go look at the unemployment level and switch this over to total private. It went up there. If you zoom in, you can see that it went up from there as well. It is slowing down. Like if you were to look at a year-over-year percentage change, you can clearly see that it's slowing down. It's down to 1.5%. And a couple of years ago, it was at over 5 to 6%. Looking at total government, this is just continues to scream upwards, right? This is honestly where a lot of the jobs are coming from, is the government. Federal government, not a huge change, 7,000. Construction has been on the rise for a while as well, and you can see that continues to go up. Manufacturing, I believe, has gone down. No, it looks like that one increased slightly, but not a lot. But it has been relatively flat for a while. And again, if you were to look at like a year-over-year percentage change of this one, you can see that sometimes it goes negative and there's not a recession. Other times it goes negative and you get pretty bad recessions. And oftentimes when it goes negative, it corresponds to a recession. And you can see that it is getting pretty close to that negative level, but it's not quite there yet. If we were to flip over to non-farm private payroll employment level, this is coming from the ADP, the Automatic Data Processing Research Institute. This is a report that we got earlier in the week. It increased by 164,000. And looking at a year-over-year percentage change of that, still relatively elevated at around 2%. So this one's not overly concerning yet. Looking at a quarter-over-quarter change, the quarter-over-quarter change has actually gone slightly up. But again, this is one of those charts where it's putting in lower highs and lower lows. And it seems like it's just a matter of time before the Fed will be forced to go back to lower rates so that to hopefully stop the bleeding in this trend. Here is total temporary help services employees. Now, this is a chart that if you're on Twitter, or X, I should say, if you're on X at all, this is a chart I'm sure you've seen many times, because this chart is one of the few labor market charts that's been in basically constant decline since this whole thing started. You can see that this metric topped out basically at the very beginning of 2022, and it's been going down ever since. Total temporary help services. To give you an idea of what this looks like, you can, just look at prior economic slowdowns. It corresponded to this dropping, right? And again, looking at a year-over-year percentage change, it's been negative for a while. But, there's still no clear and obvious signs of an economic slowdown in 2023. Doesn't mean you're not going to get one in 2024, but it's been negative for a while. But this is one of those ones that it's also coming off a fairly high level, right? It is now below the pre-pandemic highs, so that is at least notable. And I think the other issue is that there's a good chance this is just going to continue to drop, right? And who knows how far it will drop before the bleeding stops. And if you were to look at the financial crisis, you can see that it was dropping for a long time. It was dropping for a year before the drop accelerated, right? And here it's been dropping for a long time. And looking at a month over month, or let's look at a quarter over quarter change, kind of seems like it's getting worse, right? Just look at a quarter over quarter change, and maybe let's apply a 3-month estimate just to smooth it out, right? It's getting worse. Negative 1.39%, negative 1.7, negative 2. Got a little bit better for a little bit, but now it's down to negative 2. It was negative 2.4, now negative 2.9%. So it's going to the downside. It's accelerating to the downside. And again, a 25 basis point rate cut's not going to change anything. This is why the Fed often cuts aggressively, several hundred basis points, because they know 25 basis point rate cut's not going to change the needle. It's not going to move the needle on this. Now, if you were to look at job openings have gone down a little bit, but still well above the pre-pandemic highs. So that's evidence that there still is some excess. And I've sort of seen a lot of different opinions on job openings. Some people saying that they're not as useful anymore because of all the online work, sort of the work from home, and just there's been a lot more postings than there was previously. I don't know how much weight's put in that. I just look at the trend and say, well, look, it's still trending down. It's still arguably at trend. The issue, of course, being what if it drops like a rock, like the ISM. This is the thing, right? Everyone everyone is looking at the chart and it's like, all right, it looks fine, it looks fine, it looks fine. And then you get a single data point where it drops like a rock. And that's the thing that concern with, the labor market is, will you see that same type of thing show up in other charts? And if you do, how long away is that? We could look at job quits. Actually, let me go back to job openings because I want to look at some of the different sectors. Construction is always an interesting sector to look at. If it loads. Let me try reloading the page here. So let's go back to construction. So construction is where a lot of the jobs are coming from, at least a decent number of them. You can see the construction jobs have been trending up for quite a while. Manufacturing hasn't been as fortunate. I mean, you can see manufacturing jobs continue to be in a fairly large decline. You could look at retail trade. This is one that has been pretty brutal for job openings. Recently got an uptick this past month, but you can see it's not even that far from where we were at the bottom of the pandemic, right? So these jobs have been drying up relatively quickly. Durable goods, also one that's been dropping, but this last month finally the last couple of months has seen a little bit of a move to the upside, but still likely in a larger downtrend, but still above the prior trend, right? So it's all about, are you still above the prior trend or not? There's a lot of excess here that had to get removed, and I think a lot of it has been removed. The question is does it go below the prior trend line or not? Job quits level. This is one where if we think about like what is the purpose of this chart? Well, if you think about job quits, right? There's going to be fewer people that quit if they don't think they're going to get another job, right? Like if you're confident that you can go out and get another job, then you might quit your job. A lot of people might not quit until they found another job. So that's sort of a caveat to that argument. But a lot of times you're not going to quit your job if you're really concerned about the economy, if you're concerned about how you're going to pay your bills. You're not going to be as likely to quit your job. And that's why you can see that in prior recessions, job quits goes down because people don't want to quit their job. They want to keep their job. This is another metric that's been trending down for a while, and it's only now just really returned to the pre-pandemic highs, right? It's now getting to that level, and this is a pretty big drop this last month, negative 157,000. Looking at a year-over-year percentage change, you can see that it's down to negative 16.32%. It's been at this level off and on, for basically a year now, just once again showing just how much excess there has been, right? And you could look in the manufacturing sector and see that it's been trending down. You could look in the retail trade sector and see that it's been trending down and is actually well below the prior trend. Job quits rate is basically the same type of chart, just looking at it in a different way. This one had stalled out here at 2.3% for several months, and now it's dropped to 2.2%. So the downtrend continues. Now, initial claims is probably one of the most optimistic views of the labor market because the initial claims are only at 202,000. I mean, this is a really low level. In order to really be convincingly in recession territory, I think you need to see this print in the 300,000s at least. But this has been relatively low for quite a long period of time. And again, initial claims is honestly one of the most supportive views of the labor market. The fact that it's only coming in at just over 200,000, and I mean look at these levels compared to all of this over here, right? It's still relatively low. It's more important the rate of change, right? I mean, you can see there was a recession over here, coming off from levels that were this low, but it just goes to show you how tight the labor market has been. We could look at initial claims per state. This is not seasonally adjusted, so I don't know how useful it is. Continued claims dropped again this week. Still generally trending higher, but again, I don't know if this is a local high or not. We'll keep an eye on it. We can also look at number of states where the percentage of year-over-year continued claims is going up by 30%. This is an interesting way to measure the data as well, because when you look at it like this, you can see there was a spike recently up to 27%, or 27 states. So basically 27 states had a year-over-year percentage change of continued claims greater than 30%. But now it's fallen all the way back down to 8, and then these last reports is back up to 9. So this will be an interesting metric to look at because you can see that when it spikes, when it spikes up to in the 30s or the 40s, that's historically corresponded to a recession. So far, it's gotten pretty elevated, but you can see that it's come back down over the last few weeks. And then there's a number of states where the percentage of the year-over-year initial claims has gone up, and that did spike all the way up to 18. But now it fell all the way back down to 1. Now it's back up to 5. So again, Initial claims look pretty good. Continue claims look somewhat moderate. Total non-farm looks fine. Job openings, while they're falling, they're still mostly above their pre-pandemic trends, which looks fine. But then you got other sectors like new hires and the ISM that look pretty bleak. So it really does go back to what do you put more faith in, right? And we could look at things like this is the the Kansas City Fed Labor Market Conditions Index indicator level indicator. I mean, you can see how where these major economic downturns have occurred, where this metric went negative, and it's still pretty high right now. Like it's only at 0.9, still at 0.9, and arguably would need to fall quite a bit, like these cycles over here, for it to be declared a recession. And then you could look at the momentum indicator, and this one, this one's a lot lower, right? The momentum indicator for this metric isn't as optimistic, right? The counterpoint, of course, is that going over into here, you can see how long it was negative before a recession arrived, right? So I wouldn't put a lot of faith in this chart in and of itself, because it's been negative for long periods of time in the past, and it didn't correspond to a recession. Okay, so I think we'll wrap it up there. We've gone through a lot of the different, actually there was one more chart to sort of provide an update on, and that's the job openings divided by the unemployment level. It got a recent uptick this last month from 1.37 to 1.4. So basically there's 1.4 job openings per unemployed worker right now. So that is something that will likely come down in the months ahead, but still shows you just how tight the labor market has been. And I mean, again, it's still well above the pre-pandemic high. The pre-pandemic high was around 1.25 or so. And, we'll likely get there within a few months, but we're not there yet. We'll wrap it up there, guys. Thank you for tuning in. Make sure you subscribe to the channel, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.